Shares of EV maker Rivian down by 10% after the company's production target for the full year was well short of the street's estimates. The EV maker reported a wider adjusted loss per share than expected as well and said it's cutting 10% of salaried jobs here. So for the full year, Rivian now says it will produce just 57,000 vehicles. The average analyst estimate, I believe, was 80,000 as it does announce this cut of 10% of salaried jobs. It looks like the only number that did not miss estimates was the revenue for the fourth quarter, which came in at $1.32 billion versus the $1.25 billion that analysts had been anticipating. Production in the fourth quarter was also a little higher than estimated, although deliveries at just under 14,000 missed the average analyst estimate.
Yeah, and remember, headed into this report, Julie, this stock was already under a ton of pressure. It was already down about 30%. So far this year. And I think there have been kind of broader questions, right? How does a company like Rivian sort of navigate this broader slowdown in the EV market, which is tough already for a company like a Tesla, but the challenge is even more acute if you're a smaller EV startup like a Rivian.
Yeah, and there is some commentary from RJ Scaringe, who's the founder and CEO of the company, in the statement here. He talked about great progress in 2023 despite economic headwinds. And he says, we're excited about the year ahead. We're aggressively focused on driving cost efficiency throughout the business, achieving positive margins, and building on our go-to market function to support our long-term growth. And he also highlighted that the next vehicle, the R2, is still set to come out on March 7th.
All right.
We'll see.
Well, let's get more on this. To break down the EV makers report is Jordan Levy, Truist Securities Equity Research Analyst. Jordan, it is great to see you. So listen, Rivian reports, investors clearly not happy, at least initially here in the after hours, Jordan, but walk us through kind of your reaction, your response to the report.
Yeah, absolutely. And we're kind of in the midst of digesting the report. But, what it seems to be is we already kind of saw street estimates coming in a little higher than we thought the company would report because they are doing that mid-year shutdown. But it does seem like, there's a bigger than expected kind of impact here, given all the things we know about interest rates, all the things we know about the demand environment right now. And so it seems like they're reacting to that. They announced a 10% workforce reduction and in salaried employees and that sort of thing. So they are addressing what needs to be addressed, but certainly I think the production slowdown or the lower than expected production is going to disappoint some folks.
Yeah, I mean, I assume that you're amongst those folks who's disappointed, Jordan. I know that your forecast was higher than 57,000 here. Do you think that this is a factor of the general slowing in demand in the EV market, or is there something specific to Rivian?
Yeah, I think it's a mix of both, right? Rivian is still kind of in that stage that Tesla was in its early life when it was sort of in that high-priced vehicle category. Rivian still falls into that bucket ahead of when they launched the R2 vehicle, and as a result, they're maybe a little bit more exposed to these sort of macro swings. And so I do think that's sort of a part of the overall story. But I think all that said, it has to be taken into account that Rivian did execute well in 2023. So some of this is being proactive on their part, I would assume.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. Thanks for being with us. It's time for a look at developing stories this morning. I'd like to welcome in Kevin Green, senior markets correspondent here on Schwab Network. And let's talk about Rivian. Yesterday, we covered these numbers that came out after the bell. The stock moves to these lows, a huge sell-off, and a big disappointment in production. And no love for Rivian today. Tell us more about this story.
Yeah, Nicole, we are seeing the shares down about 27%, and this is after their earnings announcement came out a little bit mixed, but you're talking about that future guidance when it comes to production, and that was the biggest highlight for the quarter here. They're guiding for 57,000 vehicles for next year. The market was actually looking at 81,700 units to be delivered next year, so that was actually a significant miss, and we're not really seeing areas of opportunity when it comes to this company. Now, they did talk about interest rates and how it's actually impacting impacting the consumer and demand for the most part. And they have had to cut costs for its most popular vehicle, but that's not doing that much when it comes to trying to improve margins for these vehicles here. The revenue came in at $1.32 billion, which was above the estimates, but the adjusted earnings per share actually came in at a negative $1.36 versus the street's estimate of a loss of $1.32. So they're cutting around 10% of their workforce. Once again, the production estimates were not up to the street's expectations. Not a really good report, and we're seeing it being reflected in the stock right now, actually.
Yeah, and and then it just brings back the questions about EV demand. And for example, we're seeing Lucid also down about 19% today. A lot of folks here.
Tesla's competitors are getting hit, and Elon Musk isn't keeping quiet. Right now, EV startups are on the hot seat, losing money and disappointing investors. But the interesting thing is that Tesla is set to take advantage, and it's going to be fascinating.
Chose this approach, but now they're looking like the smartest kids in the classroom.
And so, Tom, of course, we have to talk about some of the pricing strategies here, especially when you look at pure play EVs. You sort of almost saw this sort of race to the bottom a little bit with those price cuts. But when you're a Stellantis, where it's part of your ecosystem, are you under pressure then to compete on that level, or can you afford to keep your prices, higher, especially given you still have your ICE vehicles, which people would also perhaps like to see some more deals on?
Yeah, that's a great point. That was probably, we just had actually this Stellantis management on the road with us a couple of days ago. And this was the number one question they got is, can you maintain these really high pricing? And certainly some of this pricing probably has to come down. I mean, the pricing for them is up like something like 40% in the past 3 years alone. But what we learned is that while pricing can come down, it doesn't necessarily mean that profitability suffers. The reason is right now, dealerships give a pretty high incentive amount. So even though the MSRP is very high, the incentive is also high, and the dealer kind of gets the credit for it. So what Stellantis wants to do is negotiate better with their dealers so they can come out with a lower MSRP, a lower sticker price, and a lower incentive from the dealer as well. So I do expect pricing to come down, but the other benefit Stellantis has is they're predominant in the US, at least, it's Jeep and it's Ram. These are premium products, very sticky consumer base. They could sell a lot of plug-in hybrids there, which is where demand is. So I actually think they can hold on to price better than some of the other car makers who are more in more competitive spaces like crossovers and sedans.
Tom, Stellantis CEO Carlos Tavares, one of many executives that have warned about the potential entry of Chinese EVs, particularly BYD, into the U.S. market. Elon Musk saying that if you don't have the tariffs in place, it's going to destroy other car makers. Carlos Tavares, on the other hand, saying, look, this is going to be significant, but we'd rather compete head to head. Is the threat that significant, or you think it's a bit overstated?
I mean, it's a little bit of both. You're right. I mean, I think Carlos Tavares definitely wants tariffs, right? So he's going to there's a rationale to say that this threat is very severe. But the threat isn't small either, right? I mean, the Chinese OEM, especially BYD, has some very compelling products. We learned that the Chinese OEMs have a 40% cost advantage over Stellantis. Some of this is labor, but a lot of it is vertical integration and how they work with suppliers. So there is an advantage, but there's some mitigating factors here. So in the US, you do have a 27.5% tariff that already exists. In Europe, it's about 10% tariff. Also, it's really only going to be an issue, I think, once the Chinese OEMs have local production, right? BYD's talking about a plant in Hungary and then a plant in Mexico. That's going to take a few years, right, before they have those plants up and running. So there's some mitigating factors.
Rivian recently revealed its Q4 earnings report, and it was a bit of a roller coaster, but not the fun kind. While they technically hit some milestones, the overall picture was not pretty, and it sent Rivian's stock price plummeting almost faster than a freefall. Investors understandably weren't as thrilled as the stock price took a nosedive, dropping like a rock tied to a deflated balloon. So, what does all this mean for Rivian, and how will it affect Tesla stock? Let's talk about it. But first, listen to this video clip from Bloomberg.
To talk about all of this, we've got a power panel on deck. Eric Jackson still with me of EMJ Capital, Will McDonough of Corestone Capital to talk about the EV landscape, and Ivana De La Vesca of Spear Invest, who's a shareholder in Nvidia. As we await Rivian, those numbers still not out yet. But Will, I want to start with you because this is a stock that you're a little bit cautious on, even as you're pretty excited about EVs in general.
For sure. I think, Rivian's probably public prematurely. And so when investors look at their results today, I don't think they're going to be pretty. I think is it bad or is it really bad? But really that shouldn't matter. If you're a Rivian investor, you're looking out long term on whether or not they're going to be a major player in the EV game 5-10 years out. Are they going to be the Ford of the future? And so you have to make a call on if they're going to be able to compete with the Fords and the GMs of the world, let alone Tesla. I think that they do benefit a little bit from that retreat that you reference with Ford and Hertz saying that they're cooling their jets on how fast they're driving adoption. But at the end of the day, the numbers are not going to be pretty. And if you're a public company investor trading off quarterly data, buckle up. If you're a long-term investor betting on EV adoption, I think it's a safer play, but you have to zoom out and look at it in that manner.
Eric, what do you think about that, about Rivian and whether it's just not really kind of the right fit, shouldn't be public, and might not be able to compete in this landscape?
For sure, they've all of EV is basically a no-touch area these days. I own Lucid as well, and they're reporting this afternoon. And I think that the reason why I still hang in there and still own a piece of Rivian and Lucid is that it is so bearish right now in EV land that hopefully that's a sign of a bottom. I think where Rivian and Lucid have an advantage is that the bigger players, whether it's GM or Ford, they can't really go guns blazing into EV and spend money, building up their own internal development. So I think it's a more natural thing for them to look for a partnership with one of these two names. Now, if something like that happened and the cost benefit was there for the big player, and the revenues was going to be there for a Rivian or a Lucid, that's the kind of thing that could send one of these names up a huge amount.
I will say Lucid right now is down. It's down about 4% in the pre-market as revenue missed expectations, 157 million versus the estimated 178. Their loss was a little bit wider. They see production of about 9,000 vehicles for this year. So still kind of on the smaller end in terms of meeting the demand. Are you deterred by I know I just gave you three numbers, but what do you think?
I think the most important thing for both names, Rivian and Lucid, is going to be on the call. What kind of language do they give to costs, going forward and spend going forward? Is Rivian gonna cut back its planned rollout of its Georgia facility, for example, and give some hints towards potential partnerships?
Will, last question to you. Where does this leave Tesla in the mix? It is still struggling here, especially in the context of the Magnificent Seven.
I think Tesla's in a powerful position for the same reasons why I think Rivian's interesting. Tesla is a pure EV play, but they also have many other lines of revenue and business that are accretive. I think that when you look out at how Tesla is building their manufacturing capabilities, they're building it such that they are the most prime for a partnership with a major OEM.
Rivian managed to deliver a decent number of vehicles, raking in $1.3 billion in revenue, and that's a cool 167% jump from the previous year. Nothing to scoff at. They also managed to narrow their net loss compared to 2022, so at least it's some progress there. But some things were a bit dicey. Rivian's gross margins actually slipped compared to the previous quarter, which basically means that they're losing more money on each vehicle they sell. And to make matters worse, they announced that they're trimming their workforce by 10%, which is never good. Hello, and welcome back to Tesla Tomorrow. Just like Rivian, Lucid's stock price also took a tumble. Like a domino falling after the first one gets a good shove. Now, Lucid wasn't directly involved in Rivian's drama, but things with the stock market tend to follow on from each other, and sometimes bad news for one company can spook another. In Lucid's case, investors might be worried that Rivian's struggles reflect a broader challenge in the EV market. like supply chain issues or rising costs, and they may be questioning overall demand for luxurious electric vehicles, which of course is Lucid's speciality. But where all these things start to get interesting is how Tesla could potentially benefit from its fall of its competitors for several reasons, and over the course of this video, we'll reveal some of them. But before we do, if you're liking this type of content, hit that like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. Rivian's latest earnings report just proved that the car company still has a lot of work to do on improving its margins and scaling up production efficiency. And now we know how Rivian is not really the first company to hit a rough patch, and they won't be the last. However, whether the car maker can bounce back and emerge stronger will depend on how much they learn from this experience and adapt their strategy. Even Musk said in a tweet that while Rivian's product design is not bad, the actual part of the car company's work is by achieving volume production with positive cash flow. So indeed, Rivian's got a lot to prove, especially if it wants to be a major player in the EV game.
Is it just about the infrastructure, though? Are you finding that costs, now that they're coming down, is also generating more interest? And what's that price point?
Yes, it certainly is both pricing and infrastructure. Consumers are continuing to be concerned about where are they going to charge this, how much range is there. We encourage consumers to look at installing a home charger if they're able to, or talking to their homeowners association about installing them. As far as pricing, though, we're definitely seeing a softening, as you mentioned, of both of new and used EV pricing. We're also seeing opportunities to lease these vehicles. And of course, we're seeing the new regulations come in, the $7,500 tax credit, which now is actually applied at the showroom versus waiting for your taxes. So they've simplified that process when it comes to acquiring an electric vehicle.
And Rebecca, in terms of the trends that you're looking at, because we know that for a while, it used to be all about the compact SUV, but then we saw a shift in that, looking at pickup trucks. I wasn't sure how much of that was people looking perhaps for Cybertruck alternatives and things like that, versus if that's translating into actual sales.
So we're actually seeing, some of the top interest on the site continues to be those pickup trucks for sure. And, but consumers are looking for all different types of vehicles. With electric vehicles, you've got options from a host of manufacturers, not just the Teslas and Rivians as you're showing now, but we've got the Ford F-150 Lightning, which continues to be very popular on the site. So we're still seeing a lot of interest in those compact SUVs, as you mentioned, but also in these full-size SUVs. We're also seeing consumers interested in, getting a good buy. One of the things we're looking at is that the market is moving towards a buyer's market. We're starting to see more supply. So that's absolutely one of the trends that we're watching really closely.
And in terms of the most popular, the best-selling brands in both luxury and mass market, we're looking here at fastest selling, so Toyota for mass market, Lexus for luxury. Why do you think they're so well positioned?
So I think that they always have had a good handle on balancing inventory with demand. And, typically the ones that you're showing there, they tend to say, they constrain supply a little bit, and they really are great at measuring that inventory, how much is on the dealer lot versus the consumer demand. So, and again, there continues to be a tremendous amount of interest on Cars Marketplace for the Hondas of the world, Toyotas. I think BMW is second when it comes to luxury, right behind Lexus. So
Rivian's lower than expected earnings have, in a way, rubbed off on Lucid. And yes, we know what you're thinking. Correlation does not equal causation. And just because Rivian's having a rough time doesn't mean automatically it's the same for Lucid. That theory is also very correct. However, we've also got to bear in mind that the market often reacts emotionally, and sometimes bad news can snowball into a bigger issue. Lucid's recent stock dip actually stings, and it might make it harder for the car company to raise capital in the future. No doubt Lucid still has some things going for them. The luxury Air sedan is still getting positive reviews, and they've got some exciting news and models in the pipeline. However, it will be important to see if the company stays focused on their own execution and delivers on their promises. Lucid also needs to prove that they can overcome the challenges facing the EV industry and establish themselves as a viable player in the long run. So what's next? Well, while Rivian and Lucid struggles may not directly translate to immediate benefits for Tesla, they are also in a good spot where a couple of ways could potentially impact the electric car giant and its stock. And one of the negative perception factors of Rivian and Lucid, due to their recent challenges, could actually indirectly benefit Tesla by making the overall EV market seem less risky to investors. And if investors do get spooked by the struggles of these newer players, then they might see Tesla, an already established leader, as a safer bet, and this could lead to increased investment in Tesla stock. And also, while Rivian and Lucid face difficulties, Tesla could be facing less competition in the near future, allowing for the automaker to capture a larger share of the EV market and boost up their potential sales and profits. They will also even be enhanced if Tesla can get a better hold of its batteries. The automaker is already tackling this by building their own battery factories, and so by controlling more of the production process, Tesla can potentially negotiate better deals on raw materials and streamline operations, bringing down the cost of batteries and increasing their profit margins. But there are a few things to consider. First up, the overall sentiment towards the EV market could be impacted by the struggles of Rivian and Lucid. And so if investors become more cautious about the industry's future, then it could lead to a general pullback from EV stocks, including Tesla, and that could negatively impact their stock price in the short term. It's also important to remember that the EV market is still rapidly growing and new players are constantly emerging. So any advantage Tesla can gain from the current situation might just be temporary. But there's also a possibility here of other things going on. There's so much going on that Tesla could still gain from these recent events. And it is important to remember that these are just potential impacts, and the actual effect on Tesla and its stock is difficult to predict with certainty. The market is complex and influenced by various factors, and Rivian and Lucid situations are just one piece of a bigger puzzle.
EV earnings continue to underwhelm. Shares of Rivian falling after full-year production figures came in far below estimates, down more than 26%. Rival Lucid similarly reporting weaker guidance for the year on waning EV demand, also under pressure as well. Now, a new report by Cramer says despite some waning demand for EVs, there is still interest in that market and that prices may become more affordable this year. Here with more on the report is Rebecca Lindland, Cramer's Senior Director of Industry Data and Insights. Thank you for joining us. So give us some context here. Given some of the price cuts that we've seen from some of these EVs and some of what we're seeing in terms of like reduced production, is this the year then to perhaps buy an EV? Are the prices attractive enough?
Yeah, so Rochelle, thank you so much for having me on. I think it absolutely is a year to buy an EV, both new and used, because we're seeing growth in inventory and supply of new EVs actually on the dealer lot, which is a big change from past years when it was sort of this haute couture sort of feel. Now it's ready to wear. You can go and get an EV and drive it off the lot. We're also seeing increases in used electric vehicles. So you definitely have choices now, and you have an opportunity to test drive that vehicle before you make the commitment to purchase.
Rebecca, this of course comes at a time where we're seeing a little more hesitation from drivers to make that transition to electric. What are you finding about how much consumers are willing to shell out for an EV, whether it's new or used?
Yeah, so Akiko, it's really interesting. We actually are seeing increasing interest on cars.com, our marketplace site, for electric vehicles, but we're actually seeing twice as many buyers shopping for hybrids and plug-in hybrids. And I think part of this is due to the fact that consumers really are interested in plug-in technology. They're interested in getting better fuel economy, but they don't necessarily yet feel comfortable going to a full electric vehicle. So instead, a plug-in hybrid provides that middle ground and a great transition. You get used to plugging in your car, just like we got used to plugging in our phones. This way, a plug-in hybrid allows that transition for consumers.
Rivian and Lucid's story tells a lot about Tesla, and probably the major one is that Tesla is improving its economics of scale. Imagine baking a batch of cookies, and the more you bake, the cheaper they become. Well, that's the basic idea behind economies of scale, and Tesla is using this strategy to turn out EVs to boost profits. But how exactly are they doing it? Let's see. First up, Tesla is building more factories, and the automaker's already got facilities in China, the US, and Germany, and it's constantly expanding. This lets Tesla produce more cars, and also spreads out the fixed costs across larger numbers of vehicles, thus bringing down the cost per car. Also, Tesla is embracing robots, and these automated machines can handle many tasks in the production process, everything from welding to painting. This not only reduces labor costs, but it also improves consistency and efficiency. Likewise, Tesla ditches the traditional dealership model by selling cars direct to consumers, eliminating the middleman, saving the automaker money, and potentially allowing it to offer more competitive prices. And by implementing these strategies, Tesla has also been increasing its gross margins. And this essentially means that they're making more money on each car sold, a factor crucial for many businesses to thrive. Of course, there are challenges, and competition in the EV market is heating up, with Tesla needing to keep innovating and scaling up to maintain its edge. Additionally, relying heavily on automation can be risky if there are technological disruptions or unexpected issues. However, Tesla's commitment to economies of scale and operational efficiency seems to be paying off, and the automaker seems to be building a future where sustainable transportation is accessible and affordable. And who knows, maybe these latest reports from Rivian and Lucid will actually make the journey easier and faster. No doubt Tesla's stock price will likely be driven more by its own performance and future prospects than the struggles of its competition. And so if the car company does continue to deliver strong results and meet investor expectations, its stock price could remain healthy regardless of what happens to Rivian and Lucid. What do you think? Let us know down below, and don't forget to tell us what your valuation of Tesla is. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.